So again, I mean, we're in it in my opinion is still very much a seller's market because of that demand. And I expect for that to continue probably through next year at least.
Welcome. This is the Hot Real Estate Investing Podcast, a podcast dedicated to helping others through real estate investing. Our hosts interview guests from all aspects of real estate investing who generously share valuable experiences and advice. Whether you're starting out or an experienced investor, this is the show for you.
Hello, and how's it going? My name is Travis Shelton, and welcome to the Hot Real Estate Investing Podcast, where I interview guests who want to help others investing in real estate. And today we have our special guest, our sponsor of this podcast, a good friend and mortgage loan officer at NEXA Mortgage. Welcome again, Jordan. How you doing?
Hey, appreciate you having me, Travis. Thank you.
Absolutely. Well, I asked Jordan to come onto the show today because, well, he's a lending expert, and lending is crazy right now, right? We got some of the highest mortgage interest rates, for 20-something years. And so I really wanted Jordan to come on, just talk to us about what he's seeing in the market, and what he kind of foresees moving forward. So maybe we can just kick it off, Jordan. Are you dead? Are you doing any kind of loans right now? I mean, is your business struggling? Am I still going to have a sponsor?
No, I mean, it's definitely tough. I mean, everybody in the market, everybody in this industry is feeling it. And rates this high, like you said, we haven't seen this in a very long time. So it was very easy. Obviously, over the last 8 years, rates have been low. Obviously the COVID time happened. It's been pretty lucrative to be in this industry for a while. Yeah. So this is the first adversity we've seen probably obviously back since 08, 09 in the housing bubble. So I saw a stat the other day that out of loan officers or mortgage brokers, at the beginning of the year, there was about 160,000.
Okay.
And that excludes banks because banks are under a different umbrella. But
sure.
So the NMLS recorded that over the first 2 quarters of the year, that number went from 162,000 to 90,000 loan officers.
Wow.
So you're seeing a lot of loan officers, obviously, who have been struggling, exiting the market right now. So I talked to a real estate a realtor, of mine, and he said it's very similar as far as realtors across the United States as well. So it's been tough for sure.
Yeah, it totally makes sense, and you're going to see less loans, less deals, less people needing to service those individuals out there. So it makes a lot of sense. And I know personally, right, we're doing a HELOC together right now. And I know how difficult some of those loans are, but we also know that, hey, when these opportunities do ultimately present themselves, cash is going to be king, and having that leverage is going to be needed. So what kind of loans are you kind of seeing done right now? Are you primarily seeing DSCR loans, conventional loans? Are you having to put a lot more down on a conventional mortgage right now? Help me there. Or do you see some incentives potentially in certain areas? I don't know.
Yeah, great question, Travis. So what I'm seeing right now is a lot of an uptick in HELOCs. So HELOCs for a long time kind of went away. But what's happening right now is a lot of people are pulling the equity out of their homes to be able to go reinvest it somewhere else. So that's one of the big loans that I've got a lot of interest in lately. Other than that, your standard conventional loans are still out there. Investor-wise, I know that I've talked to a lot of different investors, and they're having a tough time making the numbers work just because of where rates are. So when we look at creative financing, we're going to look at different programs. DSCR for a long time was a very good program, and it still is. Don't get me wrong. But investors are tightening up a little bit as far as those guidelines. So if you go back a year and a half ago, you could get into a DSCR with 10% down. That was the norm. Now, most lenders are looking for 20, 25, 30%. with ratios. I've seen ratios of like 1.25, 1.3. So it's definitely a different environment than you were even a year ago. So you have to look outside the box, and you have to find different ways to be able to make a deal work, whether that be bridge loans or I've had a lot of investors right now asking about seller financing, which obviously I don't like that, but I mean, it makes the deal work, and it's a good investment for you. I mean, by all means, I mean, that's what you need to do. So, but those are a couple of the loans that I've seen recently that I think are more popular right now in this tough market. So, yeah.
Yeah, that makes sense. And, it's tough to hear from the investor standpoint, I think, or people looking for second homes that, it's more that 20-25% or, because those DSCR loans were killing it for quite a number of years. It seemed like as people were being able to put 10% down and just hitting that debt service coverage ratio, like 1.25. So what you mentioned kind of home values and people are having a tough time paying. Do you foresee a bubble? Is that something that you're kind of seeing or being fearful of in your line of work?
So what everybody needs to understand is what happened, because our last reference point was the bubble. So everybody's going back to and looking at what happened in 08 and 09, and it was a completely different market. A couple things that I was looking at recently is, like, for instance, back then in 2007 there was about 4 million homes that were on the market. Today there's 1.1 million on the market. So, and that's according to the NAR, the National Association of Realtors. So it's very difficult for us to have like a housing bubble within today's market with the lack of inventory we have.
Supply.
In addition, another thing that we need to look at is in 2007, 2008, nationwide, there's about 301 million people. So obviously that number's grown, and we're about 335 million. So new households are being created every day. And with the lack of inventory there is, it simply just breaks down to supply and demand, in my opinion. Right now, there's very little supply, and the demand, as we've seen over the last few years, is only growing. So in my opinion, I think that and I'm not an economist by any means, but I have access to certain resources that I look at daily or weekly. Sure. And I don't think that we're heading towards anything like that. Okay. Furthermore, like going back to like the 1.1 million properties that are on the market right now, out of those 1.1 million, there's about 400,000 under contract. So really the number of available homes is closer to like 700,000. Which is crazy. I mean, that's half of what we normally see. Normally, you have about 1.5 million, roughly. So we're at about half the amount of what a normal market, as far as the inventory that would be on the market. So, I mean, there's a lot to consider, and there's a lot of things that are happening today that influence the housing market, but. And we'll actually go over some of those here shortly. But okay. I think that at this point, people don't need to worry about any sort of like a housing bubble.
Yeah, I mean, there's definitely a softening when you have less demand. That supply. People know that I can't get out of my 2% interest rate and go get an 8% interest rate, and it's tough for people to swallow, I think, even to want to put their home on the market. And like you mentioned, that just the inventory in general is super, super low out there. But it's not it's really tough to incentivize a seller right now to sell when they know there's not a lot of good inventory on the market, but yet, I got a good interest rate and I got to go pay probably 3 or maybe 4 times what their current interest rate is on the property. So,
absolutely. Yeah. And I'll tell you, I mean, that kind of leads into another thing is when somebody has a 2.5% or 3% on their property, like you said, they're not in any rush to sell it. So a lot of people are just flipping these into investment properties, like long-term investment properties, because rents right now are pretty high as well. So if you're you have a low mortgage and you flip it to a rental and now you clear, say, $500 a month, that makes it a little bit easier to go buy a new house. So yeah, I mean, that's a
Makes
great
sense.
point. Another thing that people need to understand as well, and I know a lot of people that are watching this probably do, but the market in 08, 09 and leading up to that, as far as like subprime lending and predatory lending practices that were happening, a lot of that kind of led to that housing bubble, where after that happened, there was a lot of guidelines, there was a lot of checkpoints and things put in place to prevent something like that from happening again. So yeah, I really think that I mean, we're not going to see the growth that we've seen over the last few years as far as like
Sure.
home values or anything like that. But I don't see there being any sort of a bubble or anything like that.
So if no bubble, I mean, do you foresee, and I mean, you don't have a crystal ball, none of us do, but uh, are you considering or like in everything that you're hearing in your industry that prices are likely to go down? Do you think, are you feeling that interest rates will go down potentially in 2024? Help me there.
Yeah, so that's a great question. I mean, really, you got to look at what's happened in the past to be able to have an understanding of what could happen in the future. So, like, even if we go back to last year, like last year is kind of when we saw rates start really going up. But if you look at home values, so the first half of last year, home values went up by 9% for the first 2 quarters, which is a lot. Like 9%
Yeah,
is a pretty large jump.
big number.
By the end of the year, they ended up settling around. They went down about 3%. And a large part of that's when rates really started to take off. So, I mean, if you look at 2022, home values, the net increase was about 6%, which is pretty good still.
Yeah.
And then you look at like so far in 2023, we started out kind of at January, February. Homes were still kind of going down a little bit, but then March and into the summer, which is, I mean, the summer is kind of the busy time in this industry. You started to see home values go back up. So right now we're on pace to land somewhere between 5 and 8% this year, which is still a very good amount. So I do think that home values will continue to increase as long as the demand is there, and the demand is there right now. So yeah, I mean, I
And
would
every market's a
imagine
little
that.
different, right? So, I mean, but yeah, I mean, you're talking overall big general stats, like probably National Association of Realtor stats. And yeah, I mean,
Yep.
there's certain areas that are definitely going to stay hot and better markets. And there's certain areas that overbuilt are going to have a little bit, like you mentioned, the opposite, a little bit oversupply. And those are probably the sites that are going to probably be a little bit hurt or see a little bit of the decrease. So to balance that out,
Yeah.
I guess,
And
yeah,
one more thing I'll add to that is like every market is different. So these are general numbers across the United States. These are averages. Another average that I saw recently as well is the number of offers on each property listed is
yeah.
3.2. So there's still that demand there, and there's multiple offers on properties. The average day that a home is staying on the market is 20 to 22 days. So again, I mean, we're in I mean, it in my opinion, is still very much a seller's market because of that demand, and I expect for that to continue probably through next year at least.
Well, and I've seen it out there too, like you mentioned, seller finance or sub two and wrap mortgages. Like if you have that option and you're a seller, like those deals are going for top dollar because interest rates can be negotiated or be less than what the current rate is, right? And so
Yeah,
those deals are flying at top dollar prices or with multiple offers. I just saw on a deal someone that I follow on social in Arizona, and they had like 20 offers on this property, right? And
yeah,
so in certain deals, like if it's priced right or you have something very unique like a sub two, potential, assumable mortgage and it's super low, like you're going to get top dollar on that. It's just when
absolutely.
someone's got to walk into a house and they're paying 8, 9, 10%, like you're not going to get that $50,000 over asking price, right? So, it makes a lot of
Yeah,
sense, but I'm seeing the same thing. If it's a good deal and it's on market, it's still getting sold. It's those deals on a major street or facing something or that's got the issues, they're not selling and they're taking severe price hits right now if they're forced to have to sell in this market. So
Yeah,
let's
absolutely.
talk maybe what to expect. We always know the holidays, it slows down a little bit. Like I always expect a little bit of a seasonal shift. Like no one wants to move Thanksgiving, Christmas, and on the East Coast there's a ton of snow. So let's talk 2024. Like what is the outlook? Is your line of work, is there optimism that rates, on the Fed will ease a little bit, or is there like, hey, hold on tight because we're going to see some more, rate hikes?
Yeah, great question. So again, I'm not an economist. There's a lot that goes into what the Fed is doing and what the market is doing. But there's a resource that I use. It's called MBS Highway, and it's
Okay.
Barry Habib and Dan Habib. I bet this is their full time job. Is they literally look at inflation, they look at CPI reports, they look at the Fed funds. They look. I mean, there's a ton of stuff that you can look at to have an idea, to be able to use what's happened in the past, to see trends and be able to kind of, in a sense, predict what's going to happen. We are in a very weird market. It's there's a lot of things happening right now that aren't normal. So, I mean, it is hard to predict. I put together like a few slides, and I wanted to go over that with this audience and just kind of show you the trends that we've seen over the last 30 years, the last year, or whatever the case may be, so that you guys can understand what's going on and be able to see what's happened in the past and what will potentially happen next year. All right, so this is what to expect going into 2024 and what I would say you want to watch for. So these are a couple of things that I put together. One is the jobs report, the Fed funds rate, the 10-year treasury versus the 30-year mortgage rate, inflation, and we've already touched on it, but some creative financing that you can look at. So first off, with the jobs report, we'll get that coming out here, I think a little bit towards the end of the month here. And what we'll be looking at in that is just basically unemployment. So when unemployment increases, which right now it's about like 3.8% is where we're at right now. Once that starts to go up, at that point, the Fed's going to take a very good look at that. And a lot of the times, once unemployment goes up, you'll start to see them kind of ease off a little bit. And I expect for that to happen over the next probably 3, 4, 5, 6 months. So that's one big thing that you want to look at. The other is this, the Fed funds rate versus the 10-year treasury note yield. So in the history of as you can see here, the past 30 years, you've seen 5 times that the Fed funds rate has been more than the 10-year treasury. So like if you look back in like the late 80s, early 90s, you'll see the first circle on the upper left. So you'll see the line for the Fed funds rate increased and actually was higher than the 10-year treasury. So when this happens, what tends to happen shortly thereafter is we go into a small recession. And I hate using that word, but I mean, it's true. So when this happens, the Fed will say, oh crap, we messed up. And then they're going to reduce the Fed fund rate. So as you can see, right after that happened, they messed up, they reduced it, and it went all the way down to 3. Well, once that happened, the 10-year treasury note yield followed. Same thing that happened in the early 2000s. And you can see, and it's just a pattern. And you can see anytime that the Fed fund rate is above the 10-year treasury, the shaded like bars that you see is a recessionary period. So this has happened 4 times over the last 30 years, and we're in one right now. And this is actually the biggest one that we've seen. And the Fed funds rate is much higher than the 10-year Treasury. So my prediction, just looking at what's happened over the past 4 instances that this has happened, is that we're going to see the Fed go, oops, we messed up. And they're going to reduce the Fed funds rate. And that will fall. In turn, I think that the 10-year Treasury will also fall, which the 10-year Treasury right now is, when I checked today, it was right around 5, just below 5. So at this point, I think that we're going to see some movement in this pretty quickly here. And then if you go to the next slide, we talk about the 10-year mortgage rate versus the 10-year Treasury. So these pretty much go hand in hand. I mean, if you know mortgages, when the 10-year Treasury goes up, rates go up. And there's a spread that is a very common spread. And as you can see, over the last 30 years, it's between about 1.75% to 2%. And that's very common. And so what we've seen now, and kind of going back to how things are a little bit different right now, a little bit weird, is if you go all the way to where we are on the right-hand side there, you see the spread has increased to 3% from 2%. So we haven't seen this in the last 30 years where technically, if the 10-year Treasury is at a 5, rates should be at a 7. But if you've looked at any pricing recently, most people are around an 8% right now. So there's a 3% spread, which hasn't happened over the last 30 years. So again, that's weird. So I think again that all of these kind of coincide together, and they're all impacting each other. But at this point, I really do think that we're going to see rates start to come down. So if you go to the next slide. So this is kind of what we're seeing here is on the left-hand side here, if you look at the 30-year fixed mortgage rate versus the core consumer price index, CPI, which is basically inflation, you'll see that on the very left-hand side there, you'll see if inflation goes up a little bit, interest rates go up a little bit. If they go down a little bit, they go down a little bit. If they stay even, the CPI, if that stays even, mortgage rates will stay even. Now, the QE period, this is basically COVID. So this is the quantitative ease of the market. And what they started to do here is they started to pump a lot of stimulus into the market. They started to, the government started to spend a lot of money. So inflation grew dramatically. And you can see that in kind of like the early 2021 timeframe where inflation shot up. And so the 30-year fixed rate mortgage rates were a little bit behind that. And so they obviously increased by the following year. Into like January 2022 is when mortgage rates started to go up. And then there was a little bit of a time period where inflation came down a little bit, rates came down a little bit. And then we've kind of gotten to the end here. So July of 2023, this is kind of what you were seeing on those other slides, is the separation between the two graphs. So the Fed funds rate, and so the blue line on the top there is inflation. So inflation has been obviously growing dramatically.
Crazy.
Rates have gone up. Inflation has actually dropped. The pink line is the inflation, the CPI. So inflation is starting to come down a little bit, but mortgage rates are continuing to rise, which is not common. Typically, again, as you can see with this, mortgage rates will kind of mirror what happens to inflation, along with the other slides that we just looked at. So we are in kind of a weird period right now, and I think that the Fed is just being a little stubborn in the sense of like they don't want to reduce rates right now. Although all of the signs that we're seeing is that we should see rates go down. So, I mean, that's a lot of kind of nerdy stuff that, again, I'm still learning on it as well, but it's just when you see these graphs and you see these trends, you can hopefully have a little bit better understanding of what is going to happen in the future. So I do think that we will see rates come down, not drastically, but we're going to see rates come down. In my opinion, probably sometime in the next, I kind of expect summer of 2024 is when we'll see that. But we'll see.
Makes sense.
Yeah.
All right, what else you got
so
for us?
The last slide here is kind of what we had touched on a little bit earlier as far as creative financing. So in this market, it is very difficult to find a product that will work to make a deal work. So when you're talking to a lender, when you're talking to a broker like myself, you want to have somebody that's going to look at all of the options for you. And I've done this for you before, where we've looked at bridge loans, we've looked at DSCR loans, we've looked at other creative financing to be able to get to make the numbers work for you to go out and purchase a property. We mentioned earlier seller financing. I mean, that's a big one right now. Hard money is always out there, but I mean, with these like hard money, I'm seeing 12, 13%. And I mean, you can probably attest to that makes it very difficult for you to buy an investment property and make it work. So another thing that
turn that quick
was a HELOC is take money out of your other investment properties or take money out of your primary residence and just go into rather than trying to do like a 10% DSCR or these days 20, maybe you put 30% down. Take the money out of your primary residence. The last thing that I have on here is actually pretty cool. It's so Fannie Mae recently just came out and they said that they would be changing their guidelines as far as their down payment requirements. So before getting into a multifamily using a conventional loan, you'd have to put typically anywhere between 15 to 25% down. So Fannie Mae just recently came out and said that they are going to change their policy where you can put as little as 5% down. So all of those people that want a house hack and go buy a fourplex and live in one of the units, it makes it much more affordable. Now you only have to put 5% down, and I mean I think it's a great program. I think it's something that will help a lot of investors right now. So keep an eye out for that. I think it starts sometime in mid-November, November 18th, I think.
Yeah, I think that's huge. I mean, I think for a lot of people, especially new investors that are looking to get started right now, to be able to come into the market and get a benefit of almost over anybody else right now, and to be able to get into a multifamily, to be able to house hack, to be able to have 3 other people potentially pay your part of your mortgage, and you live in one of the units and only have to put 5% down. There's no better option out there for a newbie trying to get started or able to be a house hack and be able to invest in that deal right now. And it should probably kind of crush a lot of investors that are looking for smaller multifamilies, because you are going to have to put 20-25% down in those sorts of deals. And so the numbers are probably going to work a lot better for the home purchaser. And so I love that program. I like that they put that out there, and I'm referring and telling everyone I know about that, especially who's, looking to buy a home right now.
Yeah. Same with me. I have a lot of investors that come to me that, I mean, they don't have 20%. They don't have 15%. So, I mean, this is going to be huge for sure.
Yeah. Well, hey, Jordan, I really appreciate your time today and dropping so much knowledge on the audience. I think, hopefully people learned a lot. I know I did. I know I knew a little bit about the Fed and different things and the 10-year Treasury note and some of those trends, but it was really nice to kind of see those trends outlined, circled, and even showing the little recession and the gray areas. And then to be able to really see that CPI and the uniqueness of where we're at and where all that COVID money and dumping in that the Fed did had really adjusted some of the interest rates and just where we're at today and where we might foresee ourselves in the near future here in 2024 heading into the into the new year. And then just some creative ways that you can get into financing, whether it be some DSCR loans or bridge loans, seller finance, or HELOCs, and then obviously the new Fannie Mae loan. I think those are huge wins for our audience and investors out there that are looking for multifamily homes. So thank you so much for being on the Hot Real Estate Investing podcast today. And to the audience, remember to take action today to move your investing forward. Take care and God bless.
Thank you for listening to the Hot Real Estate Investing podcast. Check out our website, hotrei.com, for additional content and resources. And please take a moment to subscribe and leave a review. so we can continue to bring even more value to others through real estate investing.